Hello traders and investors, and welcome back to the channel. Ever wondered what makes a stock hard to borrow and why some companies see their cost to borrow fees skyrocket? Today, we're diving deep into a fascinating case study that Growhub Limited, ticker TGHL, a technology and software infrastructure company that has recently appeared on our hard to borrow screener with an astronomical cost to borrow fee of 773.1% annualized. This is a situation that demands attention, and we're going to break down exactly what it means for potential short squeezes. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's begin with a quick look at the Growhub Limited (TGHL). Show TGHL logo/stock chart. This company operates as an investment holding firm specializing in product traceability, data analytics, and product trading facilitation solutions, primarily in Singapore and internationally. They're in the technology/software infrastructure sector with a current market capitalization of $21.08 million. Looking at recent price action, TGHL saw a decrease of 6.83% today. Over the last 5 days, it's down 13.74%. However, stretching back a bit, it's actually up a significant 56.8% over the last 30 days, indicating some serious volatility and price movement recently. Today's trading volume was 457,800 shares, which stands in stark contrast to its 30-day average volume of over 10 million shares, meaning today was a remarkably quiet day for TGHL, showing Xerox average relative volume. Share volume bars on chart highlight low today's volume. What is cost to borrow and why it matters? So, what exactly is cost to borrow or CTB? When a short seller wants to bet against a stock, they first have to borrow shares from a broker. The cost to borrow is simply the annualized fee they pay to hold those borrowed shares. Think of it like interest on a loan. When this fee becomes extraordinarily high, like TGHL 773.1%, it tells us a few things. Either there's incredibly high demand from short sellers to bet against the stock, or crucially, there is an extremely limited supply of shares available to borrow. When borrow fees exceed 100% annually, it highlights just how much demand there is, or how scarce the supply is. These fees are often calculated and compounded daily, making the annualized number quite impactful for short sellers. Why this stock is hard to borrow right now? The reason TGHL appeared on our screener is crystal clear: that eye-watering 773.1% annualized cost to borrow fee. This makes it one of the most expensive stocks to short right now. With an estimated float of 12.7 million shares, and the fact that the shares currently available to borrow are unknown, it suggests that the supply is incredibly tight. Our internal composite squeeze score for TGHL sits at 46.5 out of 100. Show score on screen. This indicates a moderate level of potential, placing it firmly on our watch list, but it's not signaling an imminent, guaranteed squeeze. It's important to remember that a high cost to borrow does not automatically mean a short squeeze is coming. It can also signify that short sellers have very strong conviction in their bearish thesis and are willing to pay a premium to maintain their short positions. Squeeze mechanics explained. For those new to the concept, a short squeeze happens like this: a short seller borrows shares and sells them, hoping the price will drop so they can buy them back cheaper, return them to the lender, and pocket the difference. If the price starts to rise unexpectedly, these short sellers face increasing losses. If the price rises rapidly, brokers might issue margin calls, demanding more collateral or forcing the short sellers to buy back shares immediately to cover their positions. When many short sellers are forced to buy at the same time, it creates a surge in buying demand. This demand, combined with an already shrinking supply of borrowable shares, creates a vicious feedback loop, driving the price even higher and squeezing out more short sellers. Dilution risk check. One critical factor to consider when evaluating any potential short squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of outstanding shares. While it can raise capital for the company, it also dilutes the value of existing shares. More importantly for short squeezes, newly issued shares can be borrowed and sold by short sellers, increasing the supply of borrowable shares and effectively negating or significantly dampening any potential squeeze. For TGHL, we checked for recent dilutive SEC filings like SMINUS1s, SMINUS3s, or 424BS in the last 90 days, and found none. Additionally, there have been no recent reverse splits for TGHL in our look-back window. This is a positive sign for the squeeze thesis, as it reduces one major headwind that often plagues hard-to-borrow stocks. Just a quick reminder, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, if you're tracking TGHL, what should you be watching? First, keep a close eye on the cost to borrow rate itself. Is it climbing even higher or starting to decrease? Show CTB chart second. Monitor the availability of shares to borrow. Any public data indicating a further reduction in available shares would be significant. Third, look for volume spikes, particularly on upward price movements. Remember, today's volume was incredibly low compared to its average, so a sudden surge in buying volume would be a key indicator. Finally, watch for price momentum that breaks through key technical resistance levels. These are all signs that the squeeze mechanics might be beginning to gain traction. The Grow Hub Limited, TGHL, with its staggering 773.1% cost to borrow and moderate squeeze score, presents a compelling case study in the world of hard-to-borrow stocks. While the high fee signals significant short interest or limited supply, it's crucial to understand that it's just one piece of the puzzle. The absence of recent dilution is a positive, but the overall market dynamics will dictate TGHL's path forward. This situation is dynamic and requires careful observation. If you found this breakdown of TGHL insightful, please hit that like button, subscribe to the channel for more unique deep dives, and let us know in the comments what other hard-to-borrow stocks you'd like us to analyze next. Happy trading, and we'll see you in the next video.